November looks bullish, which is exactly why it's dangerous. Every time the market stacks 6 straight green months, like it just did, we get one of two outcomes: some of the biggest rallies on record, or some of the sharpest reversals investors never see coming. And right now, we're sitting right on that edge. So the real question heading into this month is simple: opportunity or trap before 2025? That's why this video matters. The setups we're seeing in November aren't normal. They're the kind of setups that quietly shape next year's returns, especially if you pick your entries with discipline instead of emotion. And today, I'm breaking down 4 stocks you specifically requested, and one I'm personally buying using a system built to cut through this exact kind of uncertainty. No hype, just a process that shows when a stock deserves your money and when it deserves patience. And stick with me, because one of the stocks on this list already triggered an institutional buyout. After viewers asked me to analyze it, what that signals for retail investors is something you're going to want to see. Let's get into it. The system behind my decisions: signal map method. Let's talk about how I actually choose what to buy, and more importantly, when. I call it the signal map method. It's a system I've refined over years of trial, error, and portfolio scars. And here's the promise: follow this, and you'll avoid bad entries while compounding with precision. Here's how it works. It's a 3-part model that scores every stock I analyze. 1. Core quality, 55% weight. This is where we look under the hood: revenue growth, profit margins, cash flow, valuation ratios. Think of it as the engine. If this isn't strong, the rest doesn't matter. 2. Trend confirmation, 30% weight. Even if the fundamentals check out, we need the price to cooperate. I'm talking RSI, MACD, 200-day moving average rate of change. These help me gauge, is momentum building or fading? 3. Risk timing, 15% weight. This is the human element. Is the market overly euphoric? Is fear driving discounts? I use behavioral signals and institutional activity to spot timing asymmetry. Now picture this like a traffic signal map. Red zone, weak fundamentals, no momentum. This is a hard pass. Yellow zone, strong business, but timing's not right yet. Watch closely. Green zone, fundamentals firing, momentum lining up. This is go time. Each stock in today's video gets a score out of 100 based on this map. It's not about being perfect, just stacking the odds. Because in investing, edge doesn't come from knowing the future. It comes from recognizing signals others ignore. Let's walk through the first stock. Stock number 1, the silent AI workhorse. Everyone wants to own the next NVIDIA, the next Tesla of AI, but here's the hard truth: everyone tries to buy AI winners. Few buy what actually makes the winners possible. I had this moment a few months back. Late night, digging through earnings calls and supply chain data, I kept seeing the same name: quiet, understated, but absolutely everywhere in the AI hardware chain. It hit me. The next trillion-dollar cycle won't be led by the loudest brands. It'll be powered by the tools behind them. That's when I shifted focus from AI frontliners to AI infrastructure enablers. The company? Lam Research. But forget the name for a second. Here's the play. Lam doesn't make chips. They make the tools that make the chips. Etching machines, deposition systems, the hardware that companies like TSMC, Intel, and Samsung cannot function without. They're the shovel sellers in a gold rush. And here's the rule I live by: pick shovel makers, not headline makers. Look back at past tech booms: PCs, smartphones, cloud. The flashiest names soared out and crashed. But the quiet enablers, they compounded quietly and steadily. Lam's been through 3 full chip cycles. Their fundamentals rebound faster than most pure-play chip makers, and they've already locked in next-gen tooling contracts for AI-grade memory stacks. Here's where most people blow this entry. They chase after a headline earnings beat and pile in at the top. But Lam's chart structure? It rewards patience. Right now, the trend is extended. Momentum is stretched. I want a reversion, just enough for institutions to reload. My move? If price settles into a higher low without breaking the 50-day trend line, that's my window, not lower lows. Higher consolidation. If volume stays muted during the pullback, that's even better. I'm not trying to time a pop. I'm looking for the next base before the next breakout. This one sits in my yellow zone. High conviction business, slightly overheated trend. I'm watching closely, not jumping in yet. Let's move to stock number 2. It's totally different, but the upside might be hiding in plain sight. Stock number 2, the infrastructure mega player nobody talks about. AI compute is exploding. Models are doubling in size every few months. GPUs are stacking. Power draw is surging. But there's a silent bottleneck creeping up behind the headlines. AI compute skyrockets, but physical capacity lags. It's not about chips anymore. It's about where to put them, how to power them, how to cool them, and how to interconnect them globally. That's where Equinix comes in. They're not flashy. They're not building models, but they are the digital landlords of the AI era, owning and operating over 260 data centers across 70 cities and 30 countries. And more importantly, they've already begun retrofitting for AI-grade demand, high-density racks, liquid cooling, energy-efficient power distribution, all of it. Here's the rule. Buy the digital landlords before demand goes parabolic. You can't spin up a data center overnight. These take years. Permits, infrastructure, grid access. So companies like Meta, AWS, and Google are already locking in capacity years ahead. And Equinix is quietly absorbing that demand. In Chennai, they just launched a $69 million AI-ready facility. Not planned, live. They're pushing aggressively into emerging markets. India, Southeast Asia, LATAM, because they know AI will not be centralized. It will be everywhere. Myth. AI is purely a software story. Fact. It's a power, cooling, and interconnection story. Do prioritize companies scaling the rails. Now, let's talk entries, because the setup here is clean. Scenario A, if price consolidates above the 200-day moving average and ADX rises past 25, I'll treat it as a stealth uptrend, early institutional rotation. Scenario B, if it dips back to the $800 zone with declining volume, I'll treat it as a discount reload. Scenario C, if it breaks down hard, below 780 with rising volume, that's my watch-only signal. No entry, wait for trend repair. Right now, it's in the green zone. Solid core quality, confirmed trend, and favorable behavior signals. This one, already on my radar for staged accumulation. And the next stock? It's a classic compounder. But here's why the timing might be completely wrong. Let's break it down. Stock number 3, the automation empire in reset mode. This one's a favorite in long-term portfolios, and for good reason. Massive margins, recurring revenue, dominant enterprise footprint. It's the kind of company you want to own. But here's the issue most investors miss. Elite fundamentals don't guarantee elite timing. The company? ServiceNow. They've built the back-end workflow empire. If you've worked in a large organization, chances are you've touched their platform, whether it was IT, HR, procurement, finance, or internal ops. Once a company integrates ServiceNow, it becomes the central nervous system. Retention rates hover around 99%. Expansion revenue keeps compounding. Gross margins? North of 78%. From a core quality standpoint, this is elite tier. But here's the rule that separates pros from hopefuls. Momentum must confirm quality. Right now it doesn't. This stock is stuck in a phase I call reset mode. The chart shows classic exhaustion. Strong rally arrow, slowdown arrow, flatline. A DX is low. RSI is neutral. Volume's thinning out. It's not breaking down. It's not breaking out. It's just floating. And when stocks drift like this, it means buyers aren't ready to step in yet. Mini math check. If a $100 stock recovers 12% before confirming trend, what does that cost you? Almost nothing. What does buying too early cost? Everything. Capital stuck, opportunity missed, portfolio drag. So here's my move. Entry lane 1, breakout confirmation. If it clears its 200-day average with volume and ADX strength, I want in. That's a trend signal. Entry lane 2, controlled reversion. If it revisits its prior support with low selling pressure, think $880 zone, and RSI holds above 40, I'd consider building a starter position. But until one of those lanes opens up, it's a yellow zone stock for me. High quality business, uncertain timing. Watch, don't wish. Next up is where things get interesting. One of you dropped this in the comments weeks ago, and it just triggered a full-blown buyout. Let me show you what that means. Stock number 4, the pre-IPO gatekeeper, and the shock twist. Let's face it, retail investors almost always show up after the fireworks. You hear about a hot startup going public, you buy the IPO, and then watch it drop 30% in the first quarter. Why? Because retail investors get locked out of early-stage winners. But one company was building a different model, a rare gateway into the private markets. That stock? Forge Global. Forge built the closest thing we've seen to a pre-IPO stock exchange. They allowed buyers and sellers of private company shares, think SpaceX, Stripe, Databricks, to connect, trade, and track prices like public equities. They weren't just a broker, they were laying the rails for a new kind of market structure, one that opens up early-stage equity to a broader base. I flagged it as a frontier stock. And then The twist happened. Just weeks after a wave of viewer requests for Forge, it exploded over 100% in a single day. Why? A sudden institutional buyout. Schwab stepped in and acquired the company outright. This is where you learn the real rule of frontier investing. Frontier stocks move on a narrative shifts, not slow fundamentals. Forget trailing revenue or short-term profitability. These plays move when a big player validates the story. It's not the first time this has happened. We've seen ICE and NASDAQ scoop up niche exchanges and trading platforms before they reached critical mass. This is that same blueprint, just in the private markets era. So, what now? The direct play on Forge is gone for now, but the opportunity hasn't vanished. It's just moved. Watch Schwab's roadmap. If they roll out retail access to pre-IPO assets through their brokerage platform, it could open a floodgate. Also, track secondary data providers who controls pricing, custody, and transfer infrastructure. Those are next. Imagine being early to the next private market revolution and owning the rails before institutions showed up. But here's what happens if you chase too late. You end up paying a premium for something that was cheap weeks ago. That's why this system works. It doesn't just spot value, it spots inflection points. Now, the next stock, it's already dominant, but Wall Street just punished it hard. I'll show you why that might be the best buying moment we've seen all year. Stock number 5, the oversold giant. This is where most investors panic and where I leaned in. Because when Wall Street sees risk, I ask, what's being mispriced? Here's the setup. One of the most dominant tech platforms on Earth, 3.5 billion daily users, 81% gross margins, 26% revenue growth, just had its worst trading day in 3 years. Market panic misprices long-term dominators. The stock, Meta Platforms. Now, this isn't a bet on social media. This is a calculated move on structural AI monetization, done at scale. While most companies are selling AI tools, Meta is using AI to silently supercharge its entire monetization engine. Real numbers, Instagram engagement, up 6%. Facebook time spent, up 5%. Reels revenue, now running at over $50 billion annually. AI alone improved ad conversions by 5% on IG, 3% on FB, without launching a single AI product. But here's where Wall Street flipped out. Meta raised its capex forecast to nearly $72 billion for AI infrastructure build-out. And instantly, the stock dropped 11%. Not because of bad business, but because of spending too far ahead. That's exactly when I bought. Because here's the rule I follow. Separate temporary fear from structural dominance. When the market punishes a clear leader for investing in scale, that's not weakness. That's an opening. Now, is the technical setup great? No. RSI was crushed to 27. MACD is still negative. Momentum looks rough. But here's where I overruled the chart. This isn't a trade. This is a position. I'd rather own Meta at a 15% discount, knowing full well the AI spending is paving the way for the next 10 years of earnings power. Here's the myth Wall Street keeps repeating. AI spending is out of control. And here's the data that destroys it. Meta is front-loading capacity now to avoid bottlenecks when demand explodes. It's not expense, it's pre-positioned dominance. So yes, this one scores a pass on the system. But for me, I overrode the system, and I'm buying this with a decade-long lens. And now, let's zoom out, because it's time to stack all 5 together and show exactly where each one lands. This is the moment where the full signal map comes into focus, the 4+1 scorecard and the November decision grid. Let's bring it all together using the signal map method, our 100-point system split into core quality, trend confirmation, and risk timing. Here's how the 5 stocks stack up. Here's your November decision grid. If you want stability with a clean technical setup, Equinix is your most risk-balanced option. If you want AI exposure without chasing hype, Lam Research sits at the heart of AI hardware demand. Just wait for a cleaner entry. If you want momentum and breakout potential, watch ServiceNow for a trend confirmation. The quality is already there. And Meta, if you think long-term like I do, this discount may not come again. As for Forge, chalk it up as a win for viewer picks. It's proof that sometimes the crowd is early, especially when you filter with a real system. If you've got tickers you want me to run through the signal map, drop them in the comments. I read them all. I'm Mark. This is Dividend Hustle. See you in the next one.